Hey there, growth seekers. Welcome to another deep dive. And today we're diving into those baskets of stocks with the potential to maybe supercharge your portfolio returns. We're talking about growth ETFs.
Yeah, and we're going to be taking a look at a recent article from the Motley Fool that gives us 3 magnificent growth ETFs to buy before 2025.
Yeah, we're going to unpack these ETFs, see what makes them tick, if they live up to the hype, and most importantly, if they're the right fit for your portfolio.
Yeah, because what's right for one investor might not be right for another.
Absolutely. So let's jump right in with the first ETF on the list. The Motley Fool seems pretty excited about the Schwab U.S. Large Cap Growth ETF, ticker symbol SCHG.
Right, SCHG. And they, like this one, well, there are a couple things they point out. They say it holds 231 large cap companies.
Okay.
And a big chunk of that is in tech.
All right, so already we see that growth focus, right? Tech often equals growth.
Yeah, and it's delivered some pretty impressive returns, too. They point out it's had a 10-year average annual return of 16.48%.
Wow.
Which, if you think about the market's historical average, it's closer to 10%.
Right, so a significant outperformance there potentially.
Yeah, and then they also say another thing they like about this one is it's got a really low expense ratio, only 0.04%.
That is low. Okay, so low fees, strong historical performance, and a focus on growth, particularly in the tech sector. This SCHG sounds pretty appealing so far.
It does, but, with those high returns,
Yeah.
often comes some volatility.
Right, of course.
So that's definitely something to keep in mind.
Yeah, we can't just look at the shiny returns without acknowledging that there might be some bumps along the way. Okay, so SCHG leans into the tech sector. Let's move on to our next ETF, the Vanguard Megacap Growth ETF, ticker symbol MGK.
MGK, yeah. And this one takes a bit of a different approach. They're only focused on mega cap companies. I think it's something like 71 companies.
Okay, so significantly smaller number of companies than SCHG.
Yeah, these are the big, well-established companies, the giants of their industries.
So we're talking like the Apples, the Microsofts, the Amazons of the world, those kinds of companies.
Exactly. Big, stable.
And that stability, I'm guessing, is a big part of the appeal here. Less volatility, perhaps.
I think so. Mega caps tend to be more stable. Often with diversified revenue streams, they've got established markets.
Right.
They've kind of weathered a lot of storms.
They've been there, done that.
Right. But, and I think this is important to point out, that stability doesn't always translate to the highest growth.
Interesting. So while MGK might seem like a safer bet, there's that potential trade-off we were talking about earlier.
Right, exactly. Sometimes those smaller, more agile companies have more room to grow quickly. Right. They have that potential to be disruptive.
Yeah, they can be a little bit more nimble, a little bit more innovative maybe.
Right, and that's why diversification is so important, right?
Absolutely, yeah. Don't put all your eggs in one basket.
Exactly.
Speaking of baskets, our last ETF for today takes us right back into the world of tech, yeah?
It does, yeah. The Vanguard Information Technology ETF, or VGT.
VGT.
And this one dives headfirst into tech. So if you are really bullish on tech, this might be one you want to look into.
Okay, so VGT is all about tech, but what sets it apart from SCHG? Because remember, SCHG had a sizable chunk of tech in there as well, right?
It did, yeah. And I think a big difference is VGT is much more concentrated.
Okay.
Over 44% of this ETF is held in just 3 companies, Apple, NVIDIA, and Microsoft.
Wow.
So big players.
Huge players. So it's like putting all your tech eggs in a few very large baskets. But are those baskets really as sturdy as they seem?
Right. That's a really good question, and I think something that we need to unpack because there are some risks associated with that level of concentration.
So we're talking about concentration risk with VGT. For someone who's maybe not as familiar with that term, what does that actually mean? What are the implications there?
So it basically means that if those few companies don't do well, the whole ETF takes a hit, right?
Right. It's putting a lot of faith in just a handful of companies.
Yeah, and Apple, NVIDIA, Microsoft, these are big players. But they're not immune to market forces, right? Right. I mean, think about it. If the tech sector takes a hit, or even if one of those companies has some unforeseen challenges, VGT could feel that impact a lot harder than an ETF that's more spread out.
Right, so diversification acts as a sort of safety net. It spreads that risk around a bit more.
Exactly. That's exactly it. It's like they say, don't put all your eggs in one basket. And with VGT, you really are kind of betting on the success of these big players in the tech industry.
Makes sense. But on the flip side, for someone who's really bullish on tech, and specifically these tech giants, you can't ignore the performance that VGT has had. I mean, the Motley Fool pointed out it's got a 10-year average annual return of 20.68%. That's pretty impressive.
Yeah, it is impressive. And, if those past returns are anything to go by, this could be a real high-growth part of someone's portfolio. But, and I think this is important, you can't just look at past performance and assume it'll continue.
Of course, past performance is never a guarantee of future returns.
Exactly. So investing in VGT, you're definitely taking on more risk, but hoping for those higher rewards.
So it's really all about aligning how you like to invest with how much risk you're willing to take.
That's it. Are you comfortable with a little bit of a roller coaster ride?
Right.
Or do you prefer things a little bit more steady and predictable?
So I guess if you're someone who's comfortable with a bit of a wild ride, can stomach those dips in pursuit of the long-term growth, VGT might be worth a look.
Yeah.
But if you're more risk-averse, prioritize stability, maybe SCHG, that more broad approach to large-cap growth, or even MGK with those mega-cap companies might be more up your alley.
Right. You got to think about what you're comfortable with. You shouldn't be losing sleep over your investment.
Exactly. It's about making those strategic decisions that align with your goals, your risk tolerance, all of that.
Your peace of mind, right?
Absolutely. And speaking of SCHG, we talked about the impressive 10-year average annual return, but I know another thing the Motley Fool really liked about SCHG were those low expense ratios.
Oh, yeah, they're tiny. 0.04%. That's really low.
Which might not seem like a big deal, but when you really break it down, those fees can make a difference.
Oh, huge. Especially over time. You're talking about 10, 20, 30 years. Those fees add up to a lot of money that you could have had growing for you.
Right. It's your money. You want to keep as much of it as possible.
Exactly.
So it's not just about those returns. It's about keeping more of those returns in your pocket.
That's it. And that's why, you can't just look at the potential returns. You got to factor those expense ratios in when you're comparing different ETFs.
For sure,
Yeah.
for sure. Now, let's circle back to MGK for a second. It offers that exposure to those mega cap companies, and we talked about that stability, but can those giants, as big as they are, can they really keep up?
Right. Can they keep up with the smaller, faster growing companies?
Yeah. I mean, it's kind of the classic tortoise and the hare, right? The tortoise being those mega caps,
Yeah.
steady, reliable.
Right.
But can they really outpace the hare, those smaller, more nimble companies?
It's a good question. It really is.
Right, because those smaller companies, they might be the ones that are able to innovate quickly, disrupt industries.
And they've got that potential for explosive growth that some of these bigger, more established companies might not have.
Right, so it's about finding that balance between wanting that stability, but also knowing that you might be missing out on some of that faster growth.
And that's where diversification comes back into play.
Exactly.
So we're spreading your bets, not putting all your eggs in one basket,
Yeah.
whether that's one company or even one sector.
Right. So we've explored these 3 different growth ETFs, each with a different flavor, a different approach to trying to get those above average returns. But I think the most important takeaway is there's no one right answer. Right.
Yeah.
The best ETF depends.
Yeah, for sure.
It depends on you, your risk tolerance, how long you're planning to invest, all of that.
It's true. Yeah. It's kind of like, when you're picking a place to go on vacation.
Okay.
Are you the type of person who wants to explore a new city? Or are you more like lay on the beach and relax?
Totally.
Or maybe you want to hike a mountain. It's all different experiences, right?
Right. And different ETFs are kind of like those different vacation experiences, right?
Mm-hmm.
So maybe SCHG with its focus on large cap growth, and remember, it's got a pretty diversified approach.
Right.
That might be a good fit for someone who wants kind of a smoother ride. Like they want growth, but they don't want to be on the edge of their seat the whole time.
Exactly. And then you've got MGK, right? The one that focuses on those mega cap companies.
Mm-hmm.
And we talked about how those tend to be a little bit more stable, predictable. So if you're someone who prioritizes that stability and you're okay with maybe a little bit of a slower pace of growth, that might be a good option.
And then, of course, there's VGT, our all-in on tech ETF,
Right.
with that potential for those really high returns.
Mm.
But, of course, it comes with that added risk as well.
Yeah, and I think no matter which ETF you're considering, or if you're looking at other investments too, the important thing is to stay informed.
Yeah.
Do your research, and most importantly, stick to your strategy.
Don't get caught up in the hype.
Exactly. It's so easy to do that, especially when you see these big returns. Everyone wants to jump on that bandwagon.
Of course, yeah. Everyone wants to chase those returns.
Right. But remember, we talked about it. Past performance doesn't guarantee anything.
Never a sure thing.
No, it's not. And the most successful investors, they're the ones who can kind of zoom out, look at the big picture, and think long term. They manage their risk and they stay focused on their goals.
So as we wrap up here, think about what we've talked about today. Maybe you're intrigued by those low expense ratios of SCHG. Maybe you're thinking, MGK and those megacap companies, that really aligns with how I like to invest.
Yeah.
Or maybe you're like VGT, that tech focus, that's really speaking to me, but I want to do a little bit more digging. Whatever it is, keep those questions coming. Keep researching. Knowledge is power when it comes to investing.
Couldn't agree more.
Well, that's about all the time we have for today's deep dive. Thanks for joining us as we explored the world of growth ETFs.
Yeah, thanks for having me. It was fun.
And remember, whether you're a seasoned investor or just starting out, keep learning, keep growing, and we'll see you next time.